Welcome to the Real Estate and Wealth Podcast, your go-to resource for navigating the world of real estate investing and wealth creation. This podcast is brought to you by Calvert Home Mortgage Investment Corporation, your trusted, caring, and responsive short-term mortgage lender in Alberta and Ontario. We explore strategic and tactical solutions to elevate your real estate portfolio, drawing insights from seasoned Canadian investors and trusted advisors. In each episode, we dive into various aspects of real estate investing, including market trends, property analysis, financing strategies, risk management, and much more. Whether you're a seasoned real estate investor looking to expand your portfolio or a beginner taking those first steps, this podcast is for you.
Welcome to another episode of Real Estate and Wealth. Today we have a friend, neighbor, and business associate of mine in Calvert, Rob Townsend. Rob, welcome.
Glad to be here.
Why don't we start with telling us a bit about yourself?
I'll get to that. I have a quick aside.
Okay.
I love podcasts. I love your podcast. And I got this new podcast player called Snip. Snipped. Snip and then a D. Have you heard of this?
No.
Okay, so I always listen to podcasts. I always get fired up, but I'm always listening to podcasts while I'm walking.
Yeah.
And then I get this great idea, and then I've got to stop, pull up my phone, and try and like scribble it down. Then I get home eventually, and I'm like, what was that idea? What was that quote? What was that business idea, principle, life principle, health idea, whatever? So Snipped, you play all your podcasts through it, and you just tap your AirPod 3 times, and it clips with AI that last section. And you can set it for like, do you just want like the immediate one sentence before, or do you want a bit more?
Cool.
And then you can tag them all afterwards. So you can be like business idea, quote I like, health stuff. And for me, that's been like an ultimate hack. And then the craziest thing is it's all built with AI. So you can actually chat with it and be like, what are the 5 best quotes that I learned about this week? And
no way.
Tell me about some business principles that are from 2 months ago that I've forgotten about. So as a podcast aficionado, I found this about a week ago. I think it's $100 for a year. You get a 2-week free trial. And so far I've been super impressed.
Well, this guest is already paying off because the goal of all of this is to share ideas and educate. And
Don't you tell me shareholder value?
Shareholder value. I mean, you've educated me. So just when you hear something interesting, you'll just tap, and then when it's done, do you tap again?
No. It knows how far back to go using
wow.
the AI.
Yeah.
And then you can also like send it to your team, send it to your
like
business
when the
partners.
idea is over, that's all it will snip.
Yeah.
That's so cool.
And then when you go back, you can go right into the audio. So if it doesn't snip it perfectly, you can be like, oh no, I actually wanted this one part. Well, it bookmarks it right to that
Brilliant
part.
Yeah, I'm always like sharing, listen to this, start at this minute to whoever, like wife, colleague, partners, buddies. So it just makes that much more effortless.
It's like flawless.
And then, so the AI will only pull, like it won't pull from other podcasts. Like it'll just pull from your library.
So what you can do is it will pull what it thinks is most valuable from that podcast. So you don't even have to listen to the podcast. You could just listen to the highlights.
Right.
For me, I just took that setting off because what I like to do is I come up with my own stuff that I like, which isn't necessarily what, the typical maybe listener wants to learn about, but there is that option.
Cool. All right. Other than being a podcast aficionado, tell us a bit about yourself.
Background. A fun story I like is I'm 10 years old. I'm a stud hockey player, at least in my own eyes. And my mom and dad sit me down with my sister, and they're like, my dad's a veterinarian and a scientist. He's like, we're moving to England. I'm 10 years old. I'm devastated, but he doesn't care.
10 years old in?
10 years old in Saskatoon, Saskatchewan.
Okay. And we're
like all Calgarians, I'm from Saskatchewan.
We're moving to England or Thunder Bay, Ontario.
Thunder Bay, Ontario, yeah. Moving to England. And I get there, and my first day of class, I'm like, all these kids have these crazy accents. And then I meet the first kid, and he's like, how come you talk so funny with an accent? And that like blew my mind. I'm like, no, bro, you have an accent. Yeah. And he's like, no, you have an accent. And then you drive on the other side of the road there. And I think that has taught me like perception is reality, but you can change perception. So I was super choked to ruin my hockey career that was going nowhere, but that was such a valuable lesson to me. And I feel like life and business is you have these preconceived notions, these perceptions, but they can be challenged and changed. And my perception was I was a good hockey player. My dad's this nerd academic. And the reason I was a good hockey player is because he didn't know I needed a curve on my stick. So I was the only guy with a flat bladed stick. And so I could raise the puck. And at that time, the goalies just like lie down and no one could get the puck over him. Well, as soon as I came back, everyone could raise the puck. And it turned out I was actually a terrible hockey player.
Interesting. He's being hard on himself. He's a pretty good athlete. I've skied and played some sports with him. But maybe not the genetics for NHL.
Not NHL future. But yeah, after that, really, I got pretty serious about personal finance, wanting to be a professional investor in high school. Wrote all my license exams, graduated University of Saskatchewan, walked across the stage. Next day, packed up my car and drove to Calgary and started in the investment business. That was 2008. Went through the big wreck. Spent
good time to learn.
We'd be at these conferences and they'd be like, oh, none of the speakers are showing up because like the Dow's down 800 points. And I'm thinking, I'm 21 years old. I look like I'm 16. They tell you in that business, like you got to get 10 million in assets or you're fired within the first year. And I'm like, what am I doing here?
Yeah.
Got through it.
Working for the banks,
working for Nesbitt Burns, Bank Montreal. Did that for a while, moved to Richardson GMP, did that for a while. And then 5 years ago, started my own firm called Camber Private Wealth right here in Calgary.
And why did you start your own firm?
You know, being a financial advisor, especially at a young age, is super interesting because you meet all these successful business owners who are your clients.
Yes.
And because you're talking about your wealth, you talk about life, and it's a very like intimate conversation. So I'm this young kid, poor from Saskatchewan, trying to make it big in the big city. And I'm talking to them, and all they want to talk about is not the like hundreds of millions of dollars that they have, but they just want to talk about, oh, when I started my company, we didn't have any money, and we're in there on the weekends. I'm making my wife build the furniture, and the phone lines don't work, and we're like going through these struggles. And I could just see them kind of like light up with excitement. And I just thought, that is what it's all about for these, you know, entrepreneurial type people. Is it's the building.
Totally.
And I wanted a piece of that. And at that time, also the RIA model in the States. So in wealth management in the US, they have these independent firms.
Mm-hmm.
And a lot of wealth management problems is really at the big firms. There's so many conflicted incentives.
So many conflicted.
It's a gross industry.
It really is a shame in a lot of instances that the conflicts or the way the office manages conflicts is a detriment to the client, to who you're actually supposed to be caring for and protecting and growing their wealth.
100%.
Okay.
But all the incentives are set up at those firms not to do the best work for the clients.
Mm-hmm.
And I was really excited about what was being done in the States and could that be done in Canada? Could you have this firm that gets rid of those conflicts?
Right.
And also, like the big firms really stifle innovation. They don't want you to use your own tech stack. They want to kind of make one approved piece of software. And even though all of those advisors in that business have different business models, they all have to, you know, use the same stuff.
One system fits all. And that's around risk management, around scaling, or
everything. What
everything.
You can use for CRM, what you can't.
Yeah.
Booking meetings, you can't use Calendly. Like there's all these rules that kind of stifle innovation. And I just didn't see them really.
And innovation, whether it be like on a service standpoint, which I think really is the nuts and bolts of it all, the service, right? Like we'll get into the financial management piece, but being there for your client, isn't that a huge thing?
Huge thing. And the tools aren't really made for that. And they, you know, I got mad all the time. I'm this young guy, I'm building all this stuff. I'm kind of breaking the rules within the big firms to build what I thought would be these good client service type tools.
Mm-hmm.
But they're taking all these groups on trips that are just the highest revenue producer. And there was just no quality overlay. And I just thought, I heard this quote, you become the average of the 5 people you spend the most time with. And I just thought, I'm in a bad spot. I'm a young guy. I want to have those same stories that all my like very successful clients have.
Your favorite clients.
Trying it, digging in, going for it. And I thought just from the client perspective that we do need to champion this independence model, which I think is getting more popular. Like people now are like, go to their veterinarian and they ask, well, is this like a private equity owned firm or is this, because they know if it's like being financially engineered, maybe you're not getting the best service. I think dentists, people are being more concerned that that it does have some independence, that these incentives aren't being there. And I think more and more, at least in the US, the RIA model, these independent small firms have taken off. And we're starting to see a bit of that in Canada, but we're trying to be a champion of that within the industry. So that's basically why I started.
So that this trend has been going on in the States for some time.
Yeah, 15 years, and I would say we're at just starting it now.
Early innings.
Yeah.
Where we're seeing more and more independence.
Yeah. But Canadians love the banks.
Yeah.
So it's a hard model. But at least like in our business and most of these smaller businesses within Canada, these independent firms, you do custodian the client asset at the bank. It's just that you're not tied to the bank and selling credit cards and whole life insurance and, new issues and all this stuff.
Pushing for every last dollar.
That doesn't,
rather than the
benefit the client.
relationship. Right.
And that they're not disclosed in a lot of ways about, how people are getting paid.
Interesting. So you started it out of, let's call it an entrepreneurial passion, and that's grounded in providing better service.
A bit of a chip, I would say, on my shoulder, just to say, like, we can do it better.
Right.
And that those firms that you're marching up to the top of the stage just for revenue, we can compete against them with a service offering. It's better.
Cool. And then in terms of where you're at with the firm now, you're 5 years in. Give us a little bit about how that journey's gone.
Well, now I have all those same stories. Like first week or first month of
For better or worse.
Camber, like everything that could have gone wrong did go wrong, both personally and professionally.
Mm.
And it's kind of like that Batman movie where he's in the bottom of the cave and he's trying to get out of the prison, and he's got this big rope around him, and he makes the jump, doesn't make it, tries to make the jump, doesn't make it, and then he falls to the bottom and he's all beat up, and there's an old wise man in the corner. He's like, how did everyone ever make this? And they're like, he jumped without the rope. Like, I had jumped without the rope, so I had no choice but to
Figure it
try
out.
and make it work.
Yeah.
And you do, and like your team pulls together. It's really, I can see why those founders tell those stories, because it's like a beautiful moment of getting through it, and that's what makes it
persevering and resourcefulness. And
yeah, you got to just figure it out. None of this stuff, I don't think, in business is overly complicated. It just gets complicated because you're stacking all of these different things together.
Yeah.
But watching YouTube videos at 2 times speed can get you a pretty long ways in figuring out a lot of this stuff.
Yeah. And I'm sure that story resonates with the bulk of our listeners who are real estate investors, whether they're at the beginning of it or have been doing it for years or decades or doing it at scale. You just continue to encounter different problems, and either you find out you have the energy and resourcefulness to find solutions for it, or you decide not to and you just maintain, which there's nothing wrong with either, right? Once you have some success and you have a quality business, some people decide just to maintain rather than continue to go.
Yeah. I heard Toby Lukey give a Shopify talk, and he ended it with this quote, which was something along the lines of, a good life is falling in love with a problem and then spending your time trying to solve that problem. And unhappiness comes when you solve that problem, but you shouldn't worry, because, going so deep on one problem will come up with all these little problems that you can like dig your life into.
Yeah.
And I that's true. And I found my kind of problems that I'm kind of in love with trying to solve.
Yeah, that's something that we're really good at here, is you can always find problems when you care about what you're doing, and you can always find opportunities to make things better, whether they be better for the client, whether they be better internally for your internal clients, the people, systems, automation. You referenced AI early in this discussion, and holy man, is that ever a game changer as it relates to the ability to solve problems.
Totally.
And again, we're in extremely early innings of how we're going to adapt and change with this new technology.
Agreed.
So from a let's call it an overarching, because I love the way that you look at the asset management business. So what do you guys do? What's different? What's your philosophy?
In a big way, we're like the Ozempic of finance, fees, taxes, and crappy asset allocation. We cut the fat. But no, I think personal finance is so much driven by this notion of finding the new and the latest and the greatest. And so much of Camber's work is just let's not worry about new things. Let's study the best ideas that have already been figured out, and then just measure whether people are actually implementing those ideas. And we actually take a bunch of statistics on this, and the statistics are really low. So the average client at Camber that fills out our online questionnaire would be, over $1 million in investable assets. And in the last 2.5 years, we've done 400 of these financial plans. And the average TFSA utilization for those individuals has been 46%.
So your clients, when you onboard them, will do a financial plan?
We do a financial audit of their lives and build them a financial plan. Okay. Exactly.
Yeah.
So the research is pretty clear. Like, financial planning can add up 3% in terms of annual increase to performance done correctly, where even if you're able to pick the best portfolio managers in the world, they add about 0.5%. Right. So financial planning is totally inside of your control. Like, no one can argue mathematically that $50,000 in a taxable account wouldn't be better off if you have $50,000 of room in a TFSA account.
Right. So you'll look at these guys and gals that have $1 million net financial assets above on average, and they'll not be using all of their TFSA.
Miss TFSA, quite a heavy portion in cash,
right.
Like 30% plus in accounts that have more than a 20-year time horizon. 80% plus in Canadian stocks, which Canada makes up 3% of the world. So you should have somewhat close to a market weight. So 80% would be, way overweight. And then the fees that they pay for their overall investment management, there's comparable products that have the exact same underlying holdings for a fraction of the price. So we're just saying, competing in the investment world is a highly, highly complex game. But like filling up your TFSA or optimizing your RRSP or your RESP or creating a savings plan, like, that is totally within your control, and it's not rocket science.
Yes.
But what we find is those basics just aren't taken seriously enough. And again, I think it goes back to the incentive. Financial advisors in Canada are incentivized to trade stocks and to predict the future by the latest fund manager, and they kind of discount this like basic work that can have a tremendous amount of value over time. So that I would say really is our difference. I mean, one of my big realizations is I got a Traeger barbecue. You have a Traeger barbecue, right?
Yeah.
So I get this Traeger barbecue and I unbox it, and it's like an amazing experience to unbox a Traeger barbecue. It makes a little fort for your kids to play in.
Yeah. And
then there's like 4 bolts to put it together, which a Napoleon grill is like 3,000 bolts.
Yeah, like I was ready for an IKEA type experience where I'm going to have to call my wife in. She's going to read the instructions because she's much better at that, but we're still going to get frustrated with each other.
Totally.
But it was a remarkably easy experience.
Totally easy. And then you get this app. And this is a barbecue you pay $1,500 for one time.
Yep.
Then you get this app, and it's got all these recipes, and it's got client reviews, and it's got videos to show you how to do it. I'm like, this is an amazing experience. And it's $1,500. In wealth management, the most power any financial advisor can do, and this is proven over and over again, is financial planning. But financial planning in Canada is these like 200-page PDF reports from RBC that like I, as a total financial nerd, can't understand. So there's no way my dad is a veterinarian and my mom is a part-time teacher can understand.
Right.
So I'm like, we've got to make the Traeger barbecue of financial plans. So that's really been our rallying cry. How can we gamify these simple best behaviors? How can we be the Apple Watch, which is just like gamified the simple recipe of health? Like, get 10,000 steps a day, get 8 hours of sleep, drink some water every day, don't eat too much, don't drink too many nights. And then if you just do that consistently, you have such a good result. We wanted to bring that to these basics of personal finance.
Yeah, that I think is a really good message, which is like, if you start with the basics and follow a plan, that will pay dividends. You don't have to overthink it and get into these exotic products. I was down in Toronto last week for a private wealth conference, and it was all alternative asset products. And, these are some incredibly smart people in the room, and these are some incredibly sophisticated products. But sometimes it's like, what are we really trying to do here? Like what is the risk adjusted alpha for all of this, and how much time are we doing, financially engineering these things? Whereas for the bulk of people, it's just set it, forget it, let it compound, and just have a good plan. Put your money in your TFSA, put your money in your RRSP, put your money in your RESP, and have some sort of budget where you have a relative gauge on things.
Yeah, it drives me crazy. I go to these conferences too, and it's just everyone is after this returns mousetrap.
Mm-hmm.
And I just think, what if some of these brains and what if some of these technology companies just attacked financial planning,
Financial
and
literacy
even literacy?
Yeah.
I'm trying to champion this TFSA account. I think the TFSA account is the most understood gift that we all have as Canadians. And, I always ask people kind of, what's your TFSA balance? And if you just got the market return and made all your contributions, so the TSX return times your contributions,
Yeah.
your TFSA should be worth like $210,000
Today. If you were able to participate from, when did it launch? Like
2009. So you'd have to be 35 or older.
Yeah.
If you just made your contributions and bought one single index fund.
Yeah.
And never did anything.
Which is like 7%.
7 or 8%.
Yeah.
That gets you to that balance. We never see TFSA balances over 200,000.
Yeah.
So I ask that I'll be a bit of a controversial figure at some of these conferences, and these smart guys will tell me about these like exotic products that they're making, and I'll say, well, what's your TFSA balance? Well, 60,000. Okay, well, what happened?
What are you doing? Yeah.
And why aren't we taking this account more seriously? And I think people wrongly put in their risky assets into a TFSA because they believe it's going to be tax free.
Right.
But if you just do the basics, like the TFSA accounts are going to be on track to be worth $3 or $4 million just by compounding. Like that is such
it'll
a beautiful
compound
asset.
every 9 to 10 years, double every 9 to 10 years at that 7 to 8%.
If you want to play
if you
around
had a quarter mil and you're 35, that's a big nut when you decide to start using it.
Massive.
Yeah.
And so
anybody can really do that, right? Like
Anyone
$7,000 a year is your contribution limit today.
Yeah.
Yeah.
And we could make all of these people in Canada more wealthy if they just took this one account seriously. I was talking to some Wealthsimple people who told me that on average, TFSA balances have 60% cash. Like if we could just gamify that, correct that one problem, think how much better off Canada could be.
Mm-hmm.
And if you want to take risky bets, I would encourage everyone, like do that buy your Bitcoin or your weed stock or your AI stocks in your taxable account.
Right.
Because at least if it doesn't work out, you get some benefit.
Yeah, you get
if it does work out, you're going to be happy to pay the tax. But don't screw up this golden gem of the TFSA.
And what's great about TFSA too is another amazing feature amongst many is you're never too late.
Never too late.
Like you always carry forward that room.
Yep.
Cool.
But time is money.
Yeah. Yeah, getting it in the market is critical. Getting it working for you.
Getting it working, which is another huge problem. We fight with people all the time. Like, there's no argument to say that time and compounding isn't the most powerful factor in your future investment success.
Right.
There's all these stories about Warren Buffett. Is Warren Buffett the best investor in the world? Most people would say yes. Well, based on what metric? He's had a 20% rate of return. Absolutely astonishing. Twice what the market will give you. But Jim Simon's Renaissance Technologies is at a 66% rate of return, and he did it for 30 years. But Warren Buffett is like 10 times more wealthy than Jim Simons when he just passed away recently. And what's the difference? Well, Buffett's been doing it for 80 years. Jim Simons did it for 30.
Time.
Yeah. But it's like time is like Tom Brady in his prime, and people are just always looking for excuses to take him out of the game. It's like, U.S. election, get him out of the game. No. We got to keep Brady in the game. Time is the best thing. Get that money working. But that's probably the most common challenge that we deal with is people sitting on too much cash, not getting it working, waiting for a correction, waiting for volatility. It's always volatile. That's what you get paid for to be an investor, is the uncertainty. Mm-hmm. You just need to have the timelines to wait that out because those inevitable market downturns are coming.
Yeah. Yeah. No, that's really good insight. And, as I'm thinking through the relevancy for the audience, most of our listeners will be active real estate investors, but all of them have TFSA, and all of them should be using that as this vehicle to build wealth. And it's also a vehicle for most of them to have something outside of real estate. So a diversification tool, and going back to, I'll call it more portfolio theory. It's important to think about where you're putting your money, and having a Canadian stock index based on we represent 3% of market capitalization is probably not the best place.
Yeah, I think you just want to have all these like diversified areas of capital if you're fortunate enough to be able to do that, to just protect yourself from the future uncertainty. Because AI, like, who knows what this world's going to look like. But I do think, you're never going to do better than betting on yourself. So I believe it's very hard to create alpha by paying a hedge fund manager 2%
Totally.
a year by doing that. But do I think you can beat the market? Well, yeah, if you invest in yourself to be this active real estate business owner, I think that will lead to above average returns. But you just got to take some off the table, unless you're, the ability like the Elon Musk, who just like pushes all his chips onto the table. It's just not more realistic for most.
Yeah, but even if you are, that $7,000 a year, tax exempt, you can take it out, you can put it back. It's like, if you ever needed it, is such a nice tool that everybody should consider. Even if you are the best real estate investor in Canada.
Totally.
Why would you not have put away that $7,000 a year and sit on $250,000 today? And if you continue to do that, it's $500,000 in 8 years. Never mind if you're continuing to contribute. It's $1 million in 16. It's $2 million in 32. And if you live it's $500,000 in 8.
Yep.
It's $1 million in 16. It's $2 million in 24. It's $4 million if you continue going and getting those returns in 32.
Powerful numbers.
Yeah. Compounding, doubling every 8 years. Amazing. So we talked about kind of one common theme that you see amongst investors, and these are, relatively sophisticated people that have generated wealth, whether it be through employment, entrepreneurship, doing it on their own, and they're still making this mistake.
Yeah, I think it's kind of like, I think people know that things could be more efficient, but there just isn't a way to do it. Like, these aren't super exciting tasks to do. So things just get missed. And it gets a little bit more complicated. You stack all these things together. And the problem is every year it restarts back to zero, right? You have to redo all those behaviors again. So you just need a way to keep those things on track. But yes, these are very sophisticated people. Like, we deal with business owners, we deal with CFAs, we deal with accountants, we deal with investment bankers. And so often in these meetings, they will say something like, oh, I'm in finance, or I have a finance degree. I really should know this stuff. And I just think people should be a little bit easier on themselves. You're not supposed to know all this stuff. There's a reason that financial advisors do kind of have value to add to this world.
So you provide some value.
We try to. And I just think that people are very hard on themselves about how much they should know.
Right.
And it needs to just be more of a safe space.
Yeah.
So they can say, I don't know. So they can say, can you help me with this?
And then even what I also heard is, okay, so the basics, but making it effortless. So, every year we got to remember, we could put in another $7,000 in our TFSA. Spouse, you can do this. And you got RRSPs, RESPs. What do you guys do to make it effortless?
We always thought about, there's these CRM systems, your client relationship management tools.
Yeah.
I always thought it'd be interesting as a thought experiment to have an open kitchen. So an open kitchen, I think, keeps the kitchen staff at a higher standard, because the patrons are around the bar and they can see right into the kitchen. So they have to level up their game. I think if you saw the CRMs of most financial advisors, it would not be something that you would want to have open kitchen. It's kind of like, Jesse's grandma looks like she's about to die and has got a bunch of money, so maybe I should take him out for dinner, stuff like that.
Yeah.
I wanted to make a two-way CRM so they could, one, see all the work that we do, and two, we could help gamify these tasks. Because though we can send you reminders and try and pull out money from your accounts, there's certain things that we do need some buy-in from you. So can we have a two-way CRM login? So we use an open code piece of software, and we give clients access to it, and we try and gamify it by just putting the tasks that you have to do or that are stuck with you in red, and the ones that we're managing for you on green. Because so often I get called like, oh, did we do our TFSA? Did we do our SB? People forget. I forget personally. But just one way that you can kind of see actually our CRM is one tool that we've got. And I think if we did more of that again within the industry, we'd see some positive change.
Yeah, and that should be becoming increasingly easy for you guys with AI. Like, do you have that in app form right now?
It's in app form. We don't use AI with it currently, but we are using AI in a bunch of different ways.
Right. And then, you spoke to making it approachable where people may get hard on themselves, but I'm thinking right away again back to the listeners, like approachable, we don't need to use Rob per se. Setting up that reminder for yourself and talking about it openly with your spouse, I think, is so critical, so that you can hold each other accountable and that buy-in. Like it's something that it's accessible to everyone.
Totally.
Yeah.
Obviously, like I'm a CrossFit guy. The gym and the CrossFit equipment is like $200.
Mm-hmm.
Then you'd be done forever. But CrossFit gyms charge you like $200 a month. Well, what are you paying for? You're paying for that accountability. You're paying for someone.
A little bit of coaching, some accountability.
And if you can do it on your own and you're not getting injured because you don't need any of that coaching, then go and, doing it on your own is a total viable option. But if you can't, for me, I need someone to write something up on the whiteboard and yell at me until I do it.
Amazing. Are there other common themes that you see with your clients?
I think there's a natural growth rate to things. Morgan Housel talks a lot about this, who I'm a big fan of, but market rates have this historic rate of return, these base levels that you can go to. And let's just use 10% as an example, but long-term rates of return are 10%. All of investors' problems come from trying to squeeze that into a smaller time frame.
Mm-hmm.
So they're saying, yes, I want 10%, but I want it in 6 months instead of 12 months, or 1 month instead of 12 months.
Right.
And that's usually where all the problems arise. I think, investing is so interesting. Investing is magnitudes more complicated than brain surgery. What's going on in all the economy, everything that's going on in these companies, how things are priced, everything.
There's just an insane amount of variables.
But people
never mind psychology of the actual allocators.
Exactly.
Which is the hardest variable to gauge.
Absolutely. But people will walk into a bookstore, buy a book on investing, and then immediately try and put that into practice and come up with very firm opinions around their investment approach. Where that you don't see that in other practice. No one reads a book on brain surgery and then it's like, baby, come over here, let me I'll fix that up for you. Yeah. And so I think a lot of people have, if you wanted to learn about brain surgery, you would go to this body of evidence, all the things we've learned about brain surgery over the years. But investing is the only where people just skip over that. And so I just think studying the history of financial markets and how financial markets work, like the money ball of investing, can be a very powerful change for people to take on, instead of having these firm opinions based on what they've seen as one person, sample size of one, instead of backing up and saying, okay, what if I ran this simulation 10,000 times? What would that normal distribution curve look like?
Right. So that's more around people trying to time the market or stock pick or asset pick, rather than just do it on aggregate.
Yeah. I mean, the research is pretty clear that most of your, feelings and behaviors around money are kind of in those early puberty kind of years, and what's ever going around in your kitchen table at that time.
Right.
It's very hard to change. That seems to be cemented into psychology, your psychology, and that's why you see these really rich people who grew up during the Depression are still very, very frugal. They just can't shake that mentality of seeing an empty fridge.
Yeah.
And so, I guess my point is just we have to be very clear that the world through which we're seeing is this sample size of one. And just because it worked for you doesn't mean that it would continue to work for all these people. Or just because something didn't work. Like Morgan Housel again talks about, nothing in finance is 100% probability, which means you could be making a good decision, a high probability decision, but see a bad result.
Yep.
You could hit when you're supposed to hit in blackjack and still lose. You have to realize
you could play poker perfectly and you're still, I think, 52%. So you're going to lose 48% of the time.
Yeah. So it's some of that thinking around that to give people a little less conviction, I feel like, in their investment approach. Ultimately, the future is uncertain, and people hate that uncertainty. Like if I asked you who's going to win the Stanley Cup this year,
right?
Like, would you wager any money on that? No, like that. It seems impossible that anyone could pick that team, and you wouldn't really believe that team.
Right.
That's hockey.
Yeah.
That's like, there aren't that many teams, there aren't that many players. Compared to the stock market, it's nothing.
Yeah.
But we go to our stock advisor or financial advisors and we say, well,
everybody's
what's going to happen this year?
Future.
Should I put some money into the market now, or should I wait until the Trump election is over? Should our interest rates going to go down should I get variable or fixed? Like, we're going to these people, but if you really think about what we're asking, it's totally ludicrous.
Yeah. So get it in the market and get it diversified.
We're a big proponent of, large diversification. Again, it depends what you're optimizing for. The biggest mistakes we see are where people mismatch their asset allocation. So if you got $1 million and you want to buy a house next year, should you put $1 million in the market? No. You got a 60% chance that the market goes up, at least historically.
Right.
But next year could be 2008, where it went down 30%. It
Yep.
could be COVID, where it went down 25% for 9 months. So you just don't know. You might not be buying a house. You might be buying a condo if you get that wrong. So you just want to match the duration of the call of that capital and the magnitude of that call of that capital to the money that you're putting out the door, and think about what you're optimizing for. And so often people are optimizing for more return.
Mm-hmm.
And I would say, first, do you need more return? That's another thing financial planning can do. Like the market gives you 10.
Yeah.
We have to do financial plans as registered financial advisors at the Canadian guidelines, which work out to about a 6% rate of return.
Yes.
Every time we do a financial plan, we're like, tell us all your goals, tell us all your dreams, tell us what you want to do. And we run at 6%, everything always works.
Yeah.
So if 6 works, why are we going for 15?
Provided you're adhering to the plan.
Providing you stick to these assumptions.
Yeah, the assumptions at
that
6
you're going
work. Just now we have to have the discipline to adhere to it.
Exactly. So do you need, I always think people are going for 20% returns, which again, if you get 20% returns, you're Warren Buffett. So if 6% returns or 8% returns can, underwrite the life that you want, why is that tool not enough? Why are we trying to kill a mosquito with a shotgun? So that's the first thing I anchor to, like, what is the purpose of this capital, not just, and what tool will get us to that desired outcome. And then second, again, walk into that bookstore and look at how to increase returns. You will see thousands of books on that subject.
Right.
But all the different ones have worked for different people.
At different times, with different mentalities, different psychologies, everything.
Exactly. So I say, well, what do you do when you come to these complex problems? Well, Charlie Munger says, invert the problem. So instead of how do I grow my returns, let's think about what with certainty reduces returns.
Mm-hmm.
Fees, taxes, and improper asset allocation. So I just think we should start there when we're putting money into the stock market, examining those factors instead of just what is the newest strategy that's going to go up. Let's focus on the things that we can control, that we know reduce return with certainty.
Mm-hmm.
Because you don't get gross returns, you get net returns.
So we started off the conversation, or early in the conversation, around you moving to England and your perception, and perception is reality. And then you hit on, a lot of people will develop their feelings towards savings and investing and really money in their prepubescent and puberty years. And I know, again, a lot of our listeners are very interested in their own personal finance, but also educating their next generation, their children. So, and I think that, and again, we go back to one of the big problems in Canada is the financial literacy. So you're a father of 2 young kids. When they get to the age where they're actually interested, or even if they're not interested, where they're going to take on some of this information, how do we set our young people up for success? What should those conversations look like? What are some good ideas, other than listening to this podcast, to kind of instill those important foundational aspects or conclusions of money?
I think that's a great question. We try and deal with this problem a lot at Camber, and I'm not sure we've got it figured out. One is we have these Camber 45 hats, which they're little kids' hats, and it's called the Camber 45 because if you're small enough to wear that hat, you can turn $1 into 45 before you turn 50.
Okay.
And then we give them a little compound growth calculator to just show you those simple examples of
the eighth wonder of the world, compounding
it
interest.
works. The other one, we've got a game called Pull Cork Before Reading, and it comes with a big bottle of wine and a stack of cards. And the research is clear that talking about money at these dinner tables, as those kids get into those early teen years, is going to be important for their relationship with money. And I think a lot of people don't want to talk about it. We're trying to encourage people to talk a little bit more about it.
Mm-hmm.
So we developed this big bottle of wine and then these kind of cards, which are just cards to kind of get the conversation started. So if you had $1 billion in cash, what would your life look like? Or what is one thing that your dad taught you about money? And it's all these cards that you can hopefully open this bottle of wine with friends and family, but your kids are also maybe around the dinner table and they're engaging in that conversation. So these are some of the ways we're trying to get people to talk about it. And we're trying to be super nerdy on the finance side and the financial planning side, but then create a brand that is a bit more approachable and try and distill these complex concepts into things that people can distill. And that comes with different levels, like making it approachable to adults, but then taking it down to children. So those are some of the ways we're trying to combat that problem. But I think it's a great question to ask.
So again, not that complex. It's talking about it, learning about it, and hopefully doing something with that knowledge.
Yeah. And I think staying away from these hard, fast rules, having these conversations more as an exploration. I think as fathers, we want to prove like we know everything, but again, with money, we don't know everything. So it's just about, I don't know, just making that conversation able to happen is something we strive for.
Cool. So we talked a bit about we talked about your journey, and one of the trends, because I want to kind of wrap this up with some of your thoughts around where the financial stewardship, financial advisory industry is going. And the trend that you had mentioned is getting away from, we'll call it in Canada, the banks, to go more independent, where you're not as conflicted. You're not as restricted to do the right thing. Anything else that you're curious about or that you think the audience should be curious about as it relates to, the next year, 2, 3? I don't want to go too much into the future because of how fast the world's changing, but any kind of comments on that?
I think it's getting to be pretty hard to make the justification that some, financial advisor in Calgary is going to be able to compete against the supercomputers of the world in global finance. So I think the big trend is you're seeing money flood out of these high-priced active mutual funds that are sold at the banks and into lower cost
so
ETFs
active mutual funds or active stock pickers.
Active stock pickers.
More and more the information is coming out, and it's really clear, the data, that the long-term massive low-cost allocators are the way to go.
Very hard to beat the market over long periods of time on an after fee, after tax.
And Buffett says that today.
Yes.
Like the fact that he can beat the index is an anomaly.
Well, and Eugene
and Fonda, it's becoming harder and harder for him to beat the index.
They figured this out in the 40s. One of the big, Merrill Lynch wanted to run a financial ad that said stocks are good for the long run. And the regulator said, you can't say that because we don't actually know.
And we know they're not. Like, how many companies, individual stocks, last 30, 40 years and hold and increase value?
A tiny proportion.
Right.
Yeah, 4% of stocks account for all the wealth creation that's happened in the U.S. stock market. So it's this power law effect.
Mm-hmm.
But yeah, we've known stocks for the long run in aggregate. Yes, stocks do very well, but individual stocks, again, there's a huge dispersion in those outcomes. So I think this notion of going to your financial advisor to increase returns beyond what the market will give you is a misguided notion that's proven. Ask ChatGPT whether that's a good strategy. It's the smartest thing we've ever seen. So it'll tell you the answer or not. You don't have to believe me. But your financial advisor should do this behavioral coaching and getting you to a savings plan and optimizing all these registered accounts. And we always say personal finance is personal. So, maybe you can pay off your mortgage. Well, and mathematically, maybe that's not the best decision if we have an assumption rate of growth more in the stock market than your mortgage rate. But maybe for your family, that peace of mind is totally worth it.
Yeah. Maybe for you value being debt-free.
Exactly.
And you don't like the perception risk. However you want to quantify it, that's your goal.
And I think that's what you should be able to go to a financial advisor and say, this is a question I'm dealing with. Can you run the numbers and figure out all the stuff where I have blind spots and report the data back to me so I can make an informed decision? And I hope we see more of that. And I hope we see more independence. And I hope we see more transparency, that your advisor who's making these referrals is getting compensated for that in ways that aren't being disclosed for you. And that's just going to lead to a bad financial system in Canada. And finally, take those TFSA accounts seriously.
I love it. Well, really appreciate you joining us today. I know I got a lot out of this. I'm very hopeful the audience will too. If people wanted to reach out to you or your firm, what would they do?
I'm pretty easy to find. Townsend at camberco.ca is my email. camberco.ca is our webpage, and happy to chat with anyone about finance or life or AI or podcasts anytime.
Or barbecuing. Awesome. Thanks so much, Rob.
Cheers. Thank you.
That wraps up another episode of the Real Estate and Wealth Podcast. Be sure to hit that like button, share with fellow real estate enthusiasts, and subscribe to stay in the loop on all upcoming episodes. Get in touch with the team at Calvert Home Mortgage Investment Corporation by calling them at 1-888-752-4642 or email admin@chmic.ca. The opinions expressed in each episode belong to the individuals featured and do not represent the views of Calvert Home Mortgage. While we provide valuable insights, consulting with qualified professionals ensures that your unique financial circumstances are carefully considered, aligning your investments with your long-term objectives. Calvert Home Mortgage Investment Corporation is not a financial advisor, and we cannot advise you on making investments. There are risks to investing in real estate and the potential that you can lose all of your investment.